Good morning, Daniel.
Good morning, Dan.
Ready to be my co host every week into infinity?
It's all I've ever dreamed of.
Well, I'm glad to hear that. So, what are we talking about?
Yeah, I want to talk about what a government shutdown means for the market, whether this AI bubble in the market is real or not, and what we actually do when we tell clients we're managing investments.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Okay, so government on markets, AI on markets, and my wealth planners on markets. We'll take it. Hit me. What do we want to talk about for government shutdowns?
All right, so as of recording this, government's been shut down, quote unquote, for about 2 weeks. I think first and foremost, I think a lot of people have misconceptions of what a government shutdown actually means. It sounds pretty large and scary. So, to start, what actually is a government shutdown?
I think everybody's fairly familiar with sort of the general context of government shutdowns, but I mean, the basic answer here is that Congress has failed to pass a budget and get that approved in such a way to fund all the operations of the government. And so the government sort of switches into, call it like auxiliary power. And so only kind of necessary mandatory functions continue to work, right? So like the air traffic controllers still work, the military still works, certain important security people, infrastructure people still work. The White House, Congress still work. But essentially, because Congress hasn't allocated or apportioned money for all the detailed functions of the government, they kind of have to cut back to sort of a skeleton crew disposition until that can get rectified.
Okay, so it's essentially when, parties fail to make a deal. Does that mean it gets, reinstated or things kind of go back into motion once this deal is made, essentially?
Typically, and often these government shutdowns just happen because one party or the other has decided that they're going to use the potential shutdown as leverage for something. It often tends to be a bit of a he said, she said, right? And you can look at political issues, right? So you've got things like oh, we will not vote for this budget unless you include something in the budget that funds this particular program or that repeals this particular issue or whatever it is. It's never so clear cut, but essentially, both parties, as soon as it happens, will be like, well, this is happening because they won't agree to this little thing, or this is happening because they're demanding something outrageous. It's a game I think we keep seeing played out more and more and more frequently over the last 10, 20 years. I don't think this used to happen so often.
All right, and you mentioned TSA as something that they work, but maybe they're not getting compensated. Are there other things that are in the same case or do shut down?
Well, I actually brought up air traffic control, although I think the TSA is also still working. There's a lot of like back pay stuff that goes into this. Now, the funny thing that as I say that is, it's in the news right now. The White House has suggested that maybe federal employees don't deserve back pay during the shutdown. And also, this just sort of creates a weird dynamic. So some people are working and not getting paid. Some people are working and still getting paid. Some people are not working and may get paid after the shutdown is closed out, unless they decide to really push on that issue of, well, you weren't working, so we're not going to pay you. It's sort of a curious thing where functionally everybody sort of lives in a kind of financial and work limbo during a shutdown.
That's an interesting one. I didn't hear anything about federal workers not deserving back pay. That seems interesting to me.
I mean, it's a novel argument, and I think two sides to that argument. One side, the people making it, hey, they're not working, therefore we should not pay them. On the other end of that, like if your job is if you're gonna get like laid off spontaneously for a week or two, like every year, or every other year, or several times a year, based on the budget frequency and how often this happens, are you gonna attract the best people to your government as employees? And if you're not able to attract the best people to your government, what does that do to your government? So I follow the basic logic of if no work, no pay, but also like that's just a very stupid philosophy when it comes to the actual functioning of government long term.
So what are some, misconceptions, right? Like I think it's important we talk about what actually gets shut down, but of equal importance. What doesn't stop?
Well, I mean, as sort of mentioned, right? You have like air traffic control still functioning. You have a lot of law enforcement, military stuff still functioning. I'm not an insider to this, so maybe I'm just supposing this. I imagine like big, hefty operations kind of shut down, but like the day to day stuff still works. Not to make it a political example, but it's an easy one, right? It seems like ICE is still doing what ICE has been doing all year at the moment during the shutdown. So like somewhere in this, immigration and customs enforcement is still considered necessary. So then that's just sort of the thing, right? Like, a lot of like grants get frozen, a lot of, university programs get frozen, a lot of kind of nonprofit oriented, government funded, privately enacted things kind of come to a halt, or the money just dries up and is not available. So, but, it seems like, frankly, the lights are still on, the internet is still running, the planes are still in the air, nothing is crashing, knock on wood. That's sort of the interesting thing. There was actually I think it was a tweet from Rand Paul the other day that sort of made, I'll say maybe a nasty comment, but I get the point he was making, which was, if the government has been shut down for several weeks and nobody's noticing that anything is breaking, what does that say about how necessary the things that are being shut down are? I think somebody's fair argument to that would be, I don't know that it says anything about how necessary they are. I think we should look at the people who are doing all the lifting in the absence of their full cohort. Who are keeping the lights on, and how much stress and strain this puts on those people. But all of that to say, government shutdowns are sort of a political part of life that we deal with here in the United States.
And this has no impact on like Medicare, Social Security, and that type of thing, right?
No, I mean the checks will keep going out. I think on something like Medicare, Medicaid, again, like the checks will go out. I think you could, depending on the length of a shutdown, you might see a bit of a grind to something like Medicare reimbursements. If doctors are submitting bills to Medicare and Medicare is, understaffed or reduced in staffing and takes a longer time to pay them. But I don't think you're going to see, doctors or hospitals turning away elderly people or people on Medicaid and being like, sorry, the government won't pay us, really, really quickly. So come back when your government doesn't suck so much.
All right. So, what impact, if any, do government shutdowns, as they become maybe more prevalent than they were 20 years ago? How does this impact the stock market and economy?
It's interesting. I feel like this has evolved over time. I remember a certain period in which, a government shutdown was like this big market hedging cliff where you'd get like a lot of market activity where the market would either kind of keep trucking or it would start receding before the shutdown occurred. And that was sort of a reflection of the participants of the market, in the aggregate, either betting for or against the shutdown occurring. And then the shutdown would occur and, the market would zig, or the shutdown wouldn't happen and the market would zag, depending on how heavily the sentiment had been oriented to what did happen versus what didn't happen. In this particular shutdown, sort of interesting. The markets kind of don't seem to care. And I think it's just sort of a case study in call it sort of inoculation, right? Like the first time you get hit with a dodgeball, you're like, oh my God, my life is over. And the 20th time, you're kind of like, it happens. All that to say, I think the markets are relatively indifferent. I think if anything substantial is happening as of this recording or over the last couple of weeks, really the only big thing that's happened in the market was just sort of the sudden announcement or threat of additional tariffs on China. Market didn't like that. Bitcoin really didn't like that. But otherwise, frankly, the government shutdown doesn't really seem to have had much of an impact on markets directly.
So, is what you're kind of saying that the market is almost used to, at this point, a government shutdown a little bit?
I think so, and maybe this is just a small sample bias problem or recency bias problem. Maybe the bets were already in on the government shutting down. Right, I kind of mentioned earlier that the markets kind of have historically hedged anticipations around the shutdown. Maybe it was so thoroughly hedged and anticipated that the market hasn't freaked out because the market already expected it. So to your question are we used to it? Like I'm used to it as an investment professional. Like I'll be honest, if it wasn't like front page news, I don't even think I would notice the government was shut down half the time when it shuts down. But in that sense, right, in that context, I think the longer a shutdown goes on, the more problems can occur as a result of that, and that can cause some market effects. What are those, causes? Example, like the IRS is super duper skeleton crewed right now. Tax return season ends today. Today is the day you got to get your stuff in if you haven't gotten it out on extension. And sorry, we're recording this on October 15th. So if you're listening to this next week when this publishes, it's too late. Sorry about that. But in that context, like for people who are trying to get in last minute or something, you might see people get a tax notice automated because somebody hasn't actually reviewed the return yet, and the system doesn't recognize that it was mailed to them or something like that. So like there's a lot of stuff like that that has to be sort of contemplated as potential points of friction, and it becomes a question of how much friction has to aggregate from the government shutdown to actually cause the markets to start to react to that, or for businesses in some way, shape, or form to start to suffer as a byproduct of the government's inability to pay them.
Right. All right. Well, I guess in a weird way, it's good that we're used to them and that we're not seeing a direct impact in the things like the market. But let's talk about something that may impact the market from what I'm seeing from a lot of folks out here, which is this AI bubble. Essentially, people saying that AI, artificial intelligence, and its products are responsible for the majority of the returns in the US equities market of late. I guess first to kind of set the stage here, I think maybe it's a term we're very familiar with, but what is a bubble?
I mean, a bubble essentially refers to sort of the great speculation or belief that at certain points the market gets, inundated with irrational exuberance, right? That people just start fear of missing out buying, FOMO buying, that everybody is just piling in, piling in, piling in because it's going up, and if I don't get into it right now, I'm going to miss out, and then that exceeds the underlying fundamental value of the assets they're buying, and eventually, like a bubble, it inflates and expands and inflates and expands, and eventually, it pops, and then that pop results in a market crash or correction of some sort. Housing bubble 2007 2008, great example. And it's funny because I don't even know that that was a bubble in the way that I just described it, so much as the due diligence underlying mortgage-backed securities had just gotten so kind of terrible, and nobody in the market other than a couple of select actors, go watch The Big Short if you want to learn about that, but basically that the market had gotten so complacent with the underlying due diligence of mortgage-backed securities that when the securities failed because they were so poorly constructed and the due diligence wasn't being done, that caused just sort of a cascading and rippling effect in the derivatives market that then caused the market to correct aggressively and put Bear Stearns and Lehman Brothers and so on out of business.
Oh, I'm glad I asked. I honestly thought a bubble was a thin sphere of liquid enclosing air or gas, but it's good to clarify there.
Spit bubbles only in the world of finance.
All right. Well, on a more serious note here, is there a significant concentration of AI in the stock market? Where are we seeing this? Because this news seems to be more and more prevalent these days.
So I think it's sort of curious because I'll say like yes, but, and you can then argue that anything that precedes but is BS and everything that follows is the truth. Is our assets that are related to AI, so Apple stock, Microsoft stock, Nvidia is the obvious poster child here, right? Its value has just gone up enormously in the last couple of years. It's interesting because you look at that and go like, well, gosh, that's evidence of a bubble. This one company got so huge and so valuable so quickly. And the funny thing about that is if you look at the price equity ratio of Nvidia, and I could Google it right now and get you an exact number, I believe right now it's somewhere between like 40 and 50. And for those who don't know that term, price equity is just the ratio of what it would cost to buy the company versus how much profit it makes annually that would eventually, for you as a shareholder, pay for what you pay off what you spent to buy the ownership. So if the price equity ratio is 10, it would take 10 years of the company's existing profits to pay off a 10x multiple on the company. In this case, right, Nvidia is 40, 50. Some people might go like 40 years, 50 years, that's a really long time. Growth stocks have crazy high PE ratios, right? It's very normal. Like Tesla has a PE ratio over 200. So I say all that just to sort of say, the poster child of where the bubble could be happening, Nvidia, it's very inflated, but it's also very inflated because it has just grown its revenue enormously in the creation of products and services and so on in support of AI technology. We see the same sort of inflation in other market actors like, Snowflake or Microsoft or all these other things. All this to say, PE ratios are one indicator, many indicators. I guess I'll stop talking here. All this to just say, like, is there a bubble? I don't know. Like, stuff has grown up really quickly. AI is clearly the theme of it, but is it gonna pop? Is it like so grossly overvalued that it's a problem? I don't know that I see the evidence for that.
All right. So maybe it's not a bubble per se. Do you think the argument can be made, however, that maybe just this concentration of AI in the market makes the overall market maybe riskier as, we're kind of making a large bet on this one piece of technology?
I think it's an interesting question, and I guess I'll look at two technological comparisons. I think the question is something like Nvidia or these AI stocks, whatever companies they may be, are these, Microsoft and Apple in the 80s? Are these, up and coming, new technologies that are still in their very early nascent phases that are going to become central to our, understanding of technology and kind of cutting edge and best, versions of things? And if that's the case, sure, I think Apple went down by like 80%, like 20, 22 times or something in its history. Like, is there a possibility that some of these big AI companies, go get really big and then get really small and then keep growing over time? Some fail, some don't. I think it's all possible. Or is this just a dot com event? Right? Is it, sort of what you saw like 10 years ago where companies started just like putting crypto or Bitcoin or blockchain like in their name or on products, and that just sort of created this spontaneous inflation of value because the market was starting to get interested in those things. I think as we look at it in this particular context and go, okay, is AI, a dot com bubble type thing, or is it just an early, new technology that has a lot of kind of wild potential and speculation around it? Hard to say. If it turns out it is a bubble, then yeah, it's going to look a lot more like the dot com thing. And if it's not a bubble, yeah, then it's going to look more like an 80s thing. But what I'll point out here is whether it's the 80s thing or the dot com thing, you still have companies that sailed through that, right? You still have Microsoft, you still have Apple, you have companies like Amazon that grew out of something like the dot com bubble. So all this to say, I think we will see disruption. I think we'll see growth. I think we'll see, failure on many parts. I think we'll see that continue to be sort of a vigorous, frothy part of the market. But I don't know that I'm that worried about it.
Can you talk about that a little bit more? I think one of the most valuable things we could do as investors is just look at past performance and history to kind of learn what might happen in the future, whether it's human patterns or behaviors that we have. So, dot com bubble, right, was a bubble. If this AI thing is to look like a bubble, there might be things that start to feel or smell or look similar to bubbles in the past. What would be examples of some of those things that maybe in the future, if we start to see, would be cause for concern or just things to be wary of?
I think it's an interesting question, and I'm actually going to sort of punt on it a little bit, and I'll explain why. I am not a CFA. I'm not a markets analyst. I'm not a person who spends 12 hours a day staring at charts and lines looking for indicators. So I could talk about like leading indicators and current indicators and lagging indicators, and teach our audience something about like, well, you got to look at housing starts, or you got to look at M1, M2 money supply, or you got all these various things that people look at. The reason I'm really going to punt on it, beyond the fact that I don't think I'm actually a particularly good prognosticator, and here, maybe this is a segue into your next topic, right? We don't really do much of that here. But the big reason is there's actually a good amount of research that suggests that, and I'm just going to state the statistical findings here, the more male, the more inexperienced, and generally the more confident a market analyst is in their analysis and presuppositions about the market, there is a substantial negative correlation with their stated forecasts and the results in the marketplace. So all this to say, right, if I very confidently sit here and go, well, as a very competent man who has been in practice for a decade, but not 30 years, I really strongly think that this or that is going to happen. Statistically speaking, there's actually a strong probability that I am the opposite of correct if I get into that too much. So again, not to punt on your question too much here, but I think what I'm going to say here is I don't know that I'm qualified to answer that question in a serious sense, other than just the, again, glossary definition of leading indicators, lagging indicators, and so on. What I'll say is what matters here is really, take a zoomed out perspective. The market looks kind of jagged and scary when you look at it over a continuum of time. But if you put it on a logarithmic scale, it's often a very linear looking line when you sort of control out for inflation and compounding. And I think if you have the means, the time, and the opportunity to zoom out in your expectations of the market, whether it is a bubble or not, whether it pops or not, really doesn't matter that much. It matters in short term senses. And if you're living on a fixed income or a limited portfolio, it matters a lot more to you. But if you're a saver, if you're an accumulator, if you are, well hedged against market downturns with enough conservative assets to survive a bubble, then all that said, it just doesn't matter.
No, I appreciate the perspective, and I guess, lack of answer. But it's interesting because the guy I talked to in the sauna seems to have a very, what he believes to be accurate answer. So I think it's interesting that you as a financial professional don't feel that you can accurately predict, some of these indicators. But this gentleman who is not a financial professional seems to be very sure of the answer.
I'll make two quick references here that I think are very helpful on this. One is just to point out the existence of the reverse Kramer index. For anybody who doesn't know what I'm talking about, Jim Cramer's the Mad Money guy. He's been on TV for like 25, 30 years now, going out there, hits the big button, loud siren, says, buy this, sell this. This is a great opportunity. This is terrible. There is an index that tracks his advice, the opposite of his advice. When he says buy this, it triggers a sell. When he says sell this, it triggers a buy. And that reverse Kramer index has outperformed the S&P 500 by like a several percent on an annual basis every year. Just to highlight sort of, again, the idea that somebody even with 20, 30, 40 years of experience in portfolio management and analysis and whatnot, can just be famously and statistically incredibly wrong. The other thing I'll highlight is actually just an excerpt from a Carl Richards anecdote, which is the caution about navigating uncertain and changing terrain. And the analogy he uses for this is the idea of skiing in avalanche country. It's very common for skiers who are killed in avalanches, before they're killed in avalanches, to say things like, well, I skied it yesterday, it was fine. I skied it, I've skied this area before, I've never died in an avalanche before. Therefore, because I was right last time, I will be right next time. And so the same sort of thing about this prognostication stuff. You will, in your life, whoever's listening to this, know somebody or even be somebody who makes a wild hair bet on something, right? They bought Bitcoin back in 2009, or, they shorted a bunch of stocks in 2020, or they went to cash in February of 2020 and they bought back in late March, like whatever, right? They made some kind of risky bets and they paid off for them. And it is very common for people in that situation to then assume if they were right one time, they'll be right next time. But you mentioned sort of looking to history as an indicator of what could happen or what may happen. The classic compliance disclosure in the world of finance is historical performance is not an indicator of future results. And I think that is so important to keep in mind in the case of somebody being confident about, quote unquote, what happens next.
Awesome. Yeah, really well said. I think that kind of leads nicely into topic number three here is just what we actually do when managing investments. So to give some context and lay the groundwork here, right? We have some clients who literally probably have no clue what we do on their behalf. They just trust us and they want to be as hands off as possible, but be informed as to the important things going on. We have other clients who are the exact opposite. They're very interested in everything we're invested in and they want a full detailed report and explanation as to why. Both ends of the spectrum are fine, but it's funny, especially with the people who are very hands off. It's kind of like the dishwasher rule in financial planning. So for those that aren't planners and don't understand, essentially it goes like this: if you don't unload the dishes and your spouse didn't see you unload the dishes, you didn't actually do anything. So it would be wise of you to say casually, "Hey, I took the dishes out of the dishwasher today," so that at least you've articulated what you did and you might get a little credit or recognition for doing it. So when we talk to some clients and they're super hands off, just because we're not talking to them on a day-to-day basis about specific investments doesn't mean we're not doing anything. And being hands off is great. Um, but not all those folks probably know exactly what it is we're doing and what investment management actually entails behind the scenes. So I guess, first kind of getting into the topic a little bit, how much time would you say the team kind of spent on investments and investment related tasks?
Yeah, I mean, even before I get into that, I'm just going to tell you right now. After the credits, folks, listen to me explain or tell the story of the Magic Table comedy sketch sometime, because you just reminded me of it, and it is hilarious. Now, to your actual question, the amount of time essentially in our firm, largely speaking, I'm the chief investment officer. It's not a title that I put like on my, signature block or something, but I am the person who has done the research historically, continues to do the research, who monitors and manages the portfolios for the firm. So when a client comes onto the firm and we build a financial plan for them as a team, right, where we are taking all the facts and figures of their financial life and situation and using that analysis to determine how aggressive or how conservative they should be with their investments. I am the person who then spends the time on the back end to actually build the portfolios that they use. Generally, on a daily basis, I'm spending somewhere between maybe 30 minutes to 2 hours monitoring the market or updating or reviewing models. This just depends on both kind of conditions in the market, conditions and what's going on, and then the frequency of new information. Part of our core investment philosophy here is that we follow a very passive indexing based process. So the nice thing about that is that news about the indexes themselves or the markets themselves kind of becomes more important than news about the products. And so in that process, a lot of due diligence tends to be monitoring oriented versus discovery oriented. And within that context, then it's often much more largely built around comparison as opposed to, perfect selection.
In the context of independent planning firms that manage investments, is monitoring, as you said, more or less the norm?
It really depends. There's sort of a three different schools of thought. There's active, which is the belief that somebody working at this company or this firm is a good stock picker, or asset allocator, or is a good fund researcher, and their skill set is so substantial that they can outperform the market in general by the power of their great skill and foresight. There are a couple people like that out there. There's an interesting conversation we had about whether they are just the statistical almost necessity, right? It's sort of the if 10,000 people flip a coin, after 10 flips, there will still be some people who came up heads every single time, and so it's a question of are they just insanely lucky or do they have skill? Hard to ascertain. Otherwise, in terms of kind of how things are looked at, some people do kind of hybrid passive blends. We see a lot of this at big firms, and it's to quote Rick Ferry, who's a financial analyst or financial manager down in Texas. I guess he doesn't really manage anymore, but he used to. But he likes to use the expression complexity is job security. And this type of portfolio, this type of management is going to be characterized by investment accounts with like 20, 30, 40 investments in them. But when you actually look at the pie chart view of it, it'll be like 4 to 6 funds that make up 70, 80, 90% of the portfolio, and then 20, 30, 40 other funds that are making up like 1/4%, 1/10%. So it looks on the statement very complex, like gosh, I've got 30, 40 different funds, like what an incredible spread of things. They're doing so much work and due diligence for me. And in fact, it's kind of just using complexity to create the perception that it's far more work than it is to do that. So it's sort of an interesting world there. And then again, you have us on the passive spectrum. To give you some context here, in the last 6 years, we effectively have made 3 material portfolio changes. We made a rotation from a favoritism of healthcare sector investing versus over to technology investing, and that happened kind of in 2020. That was a fairly early change. We made a shift from long-term bond holdings kind of after the COVID crash in 2020, which did enormous benefit to bonds at the time. We switched from long-term to short-term as we approached the possibility the Fed was going to start raising rates in 2022. We then pivoted back towards longer-term bonds after the Fed stopped raising rates in kind of mid 2023. That's it. And that's all been done on a very macro oriented, large scale market environment, economic environment strategy basis, as opposed to saying like, oh gosh, this fund is 1/10% better than this other fund. We've got to switch into that fund now before it's too late. We're not trying to pick and choose winners. We are really quite good at kind of avoiding losers.
Okay, so these changes that we've made, I guess, what exactly triggers some of these decisions? Something from going from healthcare to tech, as you said, or maybe switching some of the bond durations. Is this maybe just reliance on current events, or are these things we're considering in the long term and taking a long time to, you know, have action on?
It was it's always been very long term oriented. The switch on healthcare really was sort of we were testing a hypothesis early on, and just was not evidence for that hypothesis on a going basis. The idea here was that healthcare is a kind of market necessity, right? People need healthcare; it's not optional. Therefore, it'll be sort of a little bit defensive, but also healthcare had shown really strong growth. We see a lot of kind of stock market profit for healthcare companies in the insurance world more than the actual healthcare provider world. So healthcare as a sector is kind of a blend of insurance companies, some private medical providers, and then a lot of like big pharma. And we just weren't seeing the evidence for the hypothesis. So we pivoted back to technology, which before I took the firm independent had been my sort of favored sector for a sector orientation. Technology, for those who are not familiar, is tends to have a very high average rate of return, but is very volatile. It is sort of a risk on asset class. And so in that sense, it is just sort of the kind of the speculative corner of our portfolios that is a little bit more aggressive than not. In terms of shifting from long-term bonds to short-term bonds back to long-term bonds over kind of a 4-year narrative, largely that's just down to Fed rate. Hey, there is a basic calculation for duration and modified duration that essentially can tell you, hey, if interest rates or the risk-free rate changes in the marketplace, here's how that'll affect bond prices. When rates are going down, long-term bonds tend to profit. When rates are going up, long-term bonds tend to get hurt. And so we had long-term bonds going into 2020. The Fed cut rates, that juiced their returns, terrific. Rates are essentially zero for a while. Now we're expecting rates to start going up. That's going to hurt our long-term bonds. Let's go ahead and pivot out of those to short-term bonds to avoid that harm. Lo and behold, rates go up. Long-term bonds get shellacked. Short-term bonds don't really feel the pain that much. We get to the end of this rate raising environment as inflation finally comes down and the Fed kind of cools its forward looking expectations around inflation. Okay, we can start creeping back up the spectrum towards longer term bonds as the yield curve starts to kind of normalize. And in that particular sense, it's sort of a technical term, but when the yield curve is inverted, that means short term things are paying more than long term things. And so as short term things have come down in rate and long term things have started to go up in rate, and you've sort of seen the teeter totter switch sides, that's where we've kind of started to expose ourselves to long-term holdings again on the bond side.
All right. Yeah, that makes a lot of sense. And I really like what you said about we're really good at avoiding the big losers, right? Maybe we're not chasing the giant winners per se. Um, it's kind of like tennis or even golf, I guess. A lot of amateur players that aren't pros, like how do you get better at tennis? It's not by figuring out how to hit the perfect serve into the corner consistently. It's can you get the ball over the net consistently and not make, unforced errors essentially. Or it's in golf, right? Can you keep the ball in bounds and get the ball on the green in regulation, as opposed to hitting it OB 5 times around? If you do both those things in both those respective sports, you're going to be better than a lot of amateurs just to begin with because you're not making the unforced errors, which is kind of similar to maybe avoiding the big losers instead of chasing the big winners, meaning the giant putt on 18 or the brilliant serve that you might hit 1 out of 5 times.
Yeah, I mean the basic thing here is realistically this applies kind of in good seasons and bad seasons. A good example of an unforced error from our perspective is getting out of the market, right? People have this current events temptation to go like, oh gosh, Biden's in office. We got to get out of the market. He's going to ruin the market. Oh gosh, Trump is in the market is in office. We got to get out of the market. He's going to ruin the market. There are triggering events that happen. There are bad things that happen in the economy, in the marketplace, in the world that cause stocks, bonds, whatever else to go down. That is just a inevitable expectation of life. But the data on this is just super, super, super clear. As long as you don't have a short-term need that could be at risk from losing money in the short term, if you have a long-term disposition, 5 years, 10 years, 15, 20, 30, 40, 50, 60, 70, right, your whole life, if you have a long-term disposition, the act of trying to kind of jump out of the way of the market possibly going down or jumping out of the market as it's already gone down versus then trying to jump in at the right time in the future, the probability that you get it right is just incredibly awful. And so in that particular sense, right, we tend to look at that unforced errors thing in the sense of like, okay, just because tech is down or energy is down or the US market's not doing as well as the international market this quarter or whatever it is, we don't, respond to that. We try to avoid being reactive as much as possible because emotional decision making in the marketplace has a very strong relationship with those unforced errors you're describing.
So I had a conversation with someone recently, and they asked what returns we use for clients and like how we use those returns to like measure success. And I kind of talked about how we have benchmarks and we use those, as benchmarks. But besides the actual returns, right, and the numbers and percentages associated with them, how would you define, success in investment management for the firm beyond just those returns?
I mean, simply put, it's are we developing portfolios and managing money in such a way that it is making it easy for our clients to live good lives, right? To accomplish their goals, to get to attain their ambitions, have the experiences they want for themselves, their family, their children, their community, whatever is meaningful to them. A great example. A client reached out yesterday and was sort of asking, "Hey, we were thinking about investing in this thing. What are your thoughts on this thing?" Also, just pop fly question here. Are we in a bubble? And I answered their question on the other investment and whatnot, and then I sort of brought up even like the AI question that you brought up today, which because another client asked me about that recently, and I made the point to this client like, look, in the time that we've managed money for you, you gave us this much money. You've spent this much money, which I won't give the numbers here, but essentially you've spent something like 40% of the money you gave us to start with in the first place. And today you still have more money than you started with than you gave us to start with. Um, whether we're in a bubble or not, like it's a fair question and it's a thing to be concerned about. But I think what's much more meaningful for you is that you've been able to spend these hundreds of thousands of dollars over the last couple of years, having a great quality of life, enjoying yourselves, doing meaningful work, impacting your community, and so on.
Yeah, I really like that answer. Is there anything we haven't really talked about that, for any clients or potential clients listening, you wish they knew or understood about us managing investments on their behalf?
Yeah, some of my I know some of my frequent listeners are gonna know I'm talking about them here. So gentlemen, because they're all gentlemen. Gentlemen, you are wonderful people. You are some of my favorite clients. Please don't take offense to this. Um, it's okay that you want to manage your own things versus us having us do it for you and whatnot. Like that's fine. You are all competent. You're doing a great job of it. I've talked in the podcast before about the that handful of clients who do a good job with it, so it's not a problem. But when I want to speak now to the more broad audience of people who are clients, aren't clients, thinking about become clients, whatever it is, um, a lot of times discussing investments that we don't manage, your 401k, your brokerage account you have over at Vanguard, whatever it is, a lot of times it's an enormous amount of work on our part to inefficiently try to give you advice or guidance relative to just doing it for you. Or, and this is maybe the worst part about it, there's an issue here where often we can spend a lot of time talking about a thing and then getting no value from it, right? I've been really been thinking about losing weight. I've really been thinking about going to the gym. I've really been thinking about taking that trip. I've really been thinking about quitting that terrible job or taking that next opportunity or starting that business. It's great to talk about these things. Like it's fine to discuss those things, but it's the action that really matters. And quite often, what we found over time and why we're sort of starting to shift from this may manage to shall manage perspective on investments is just that what we've seen over and over is that amongst many people who manage their own assets or don't want us to do it for them or whatever it is, they don't do a very efficient job. I don't want to say they're not doing a good job, but like there's a disproportionate amount of work that goes into it for them, for us. And the question I always want to ask, and the thing I'm always thinking about is how does this actually better your life? How is your quality of life, your experience, your welfare, your family's welfare? How are your ambitions and objectives and goals better served by doing this in the least efficient way possible? And maybe somebody has a really good answer for that in their individual or select case. But that is sort of the thing I always think about here is what good is this doing, right? How is this in your best interest? That's always what kind of comes to mind for me, and I do wish people understood that more. Managing money for us is not because we love it or because it makes us more money or something like that. Point of fact, I find investments to be the most boring part of personal finance. But that is sort of the fascinating thing for me that I wish people understood more.
Listen up, boys.
You're all wonderful people, I promise.
Hey, well, that's great, Dan. That's really all I got for this week.
Okay. Well, then, as always, you know what I have to ask you.
Yes, I do. So, um, like the AI quote unquote bubble, call it whatever you want. dot-com bubble, housing crisis, COVID, um, even the government shutdown. I'd call these all sort of maybe one-off events. The funny thing about one-off events, whether they're things that happen in the stock market economy, whether they're unexpected expenses, gifts or flat tires, or one-off events that don't occur frequently in your regular life, I think it's important to note one-off events might be different every time, but they will consistently occur. It's so funny how many people we speak to, especially with like budgeting. They're like, I spent, $80,000 this year, whatever. And they're like, but, next year it'll be 75 because I had this weird $5,000 couple things that came up this year. It won't happen again. You're probably right, but something more likely than not will occur the next year, probably around more or less that same sum. And that goes for investing, it goes for cash flow, it goes for insurance, it goes for most areas of financial planning. Um, the thing might always be different, but there will always be a thing. And I think that's important to note, whether it's an emergency fund or just understanding around how much you spend, or investment management for that matter.
No. It's funny how one-time events, never before, never again events, just always seem to happen a little more frequently than we would expect.
There it is. Cheers, Dan.
Cheers. The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast. Okay, as promised, I have to now tell you the story of the magic table. This is a like a comedy sketch. You can probably find it on YouTube pretty quickly. But essentially, this man's talking to his girlfriend or his wife, and she's like, honey, I really need you to pick up after yourself a lot more. I'm just tired of picking up after you, so on and so forth. And he's like, all right, honey, I didn't want to tell you this because I wasn't sure it was real, but I think I'm gonna have to tell you, okay? And so he like takes her into the living room and he goes like, look at this. See this coffee table? Anytime I leave plates on it, cups on it, laundry on it, anything, trash, whatever, anything, the next day it's gone. And she's looking at him like, you are the dumbest person alive. It kind of cuts away, and then like the next scene is like him standing there, and now there's this guy there, and he's like, okay, I told her about it, but I she's gone. I haven't seen her all day. I'm worried. I think she might have fallen onto the table.
I'm glad I stayed around for that one.